Robert, thank you very much for joining us today. How are things in Toronto?
Things are looking beautiful here finally. How are you, Jimmy?
I'm very well. Yes, finally we have some sunshine, but even though it's sunny in Toronto, it is not so sunny on the Canadian economy. And this is what I want to discuss with you. You and your team at Rosenberg Research have done a lot of work on the Canadian economy and also the real estate market. And before we do the deep dive here, I want to lay a little bit of a foundation for our viewers to give them an idea of where we are right now and how we got here. And I want to start with the GDP. If you look at the GDP in 2015, it was at 1.6 trillion. These are all US dollars. Here we are 10 years later in 2025, it's at $2.2 trillion. That's in nominal terms. A lot of that growth came from inflation. And if you look at it, GDP from a per capita point of view, it's gone from $45,000 in 2015 to $55,000 now. So very tepid growth. If you compare that to the US, they went from 56,000 to 85,000 over the same time period. So that provides a little bit of a backdrop and where we are and how we got here. So I want to get your views on the Canadian economy, where we are right now in terms of GDP, and where do you see it going in the coming quarters?
Right. Well, Canada has two different types of economic problems at the same time. We have a structural problem and we have a cyclical problem. So structural meaning we're growing at a very low pace. We don't do a lot of investment in capital formation. We don't do a lot of R&D. Productivity growth has been very slow. Most of the growth in the nominal number has been inflation, and most of the growth in the real number has been population. And so when you look at it from a per capita point of view in real terms, it's not very good. And then also right now, we're flirting with a recession. I don't think we're quite there yet, but first quarter GDP was very close to flat, and the build-in for the second quarter is also looking pretty low, might be zero point 0.5, zero point 0.6, something like that. And so we're in a cyclical downturn on top of having a very slow, longer run growth rate.
And Robert, I want to get your views on this GDP per capita. There's a huge disparity between ours and the US. And once again, if you look at the past year, we're currently at 55,000 per capita. The US is at 85,000. Why such a large gap between the two countries?
Well, there are a few different reasons, but the core reason is that U.S. productivity growth and capital formation has been notably higher than in the rest of the world. And so it's not just Canada that lags behind. If you look at the UK, if you look at Germany and France, they have a very similar dynamic over the last decade with the United States. In particular, there seems to be something about the US economy that makes it extremely adaptable to shocks. And so the US recovery from the pandemic was so fast and involved so many productivity increases as firms used new technologies and reshuffled workers. And these other economies, notably ours, just don't adapt as quickly. And so that's a big part of it. And then the other slow moving part is we really struggle with capital formation, business fixed investment. So much of our investment goes into housing. So much of government spending has been diverted away from long-term R&D towards other things. And so you just don't see a lot of those kinds of investments that you really need to have rapid productivity growth. So it's a combination of factors, but it really adds up.
So, as you mentioned, we have a slowing economy, and you said it's flirting with a recession. And when you get a slowing economy or a recession, you get a lot of layoffs. So, I want to talk about the unemployment rate right now. And every month, it seems like there's more and more companies laying off people. TD Bank, one of the largest banks in Canada, just announced that they're going to lay off over 2,000 people within their corporation. Hudson's Bay, a large department store in Canada. It's been around since 1670 in one form or another. Just announced that they're shutting down. They're declaring bankruptcy. They're laying off over 8,000 employees. Southern Ontario has a very strong auto sector. A number of auto companies have announced layoffs. General Motors has announced that they're going to lay off over 1,000 people between two plants in Southern Ontario. Stellantis, another large automaker, has announced a short-term layoff at one of their plants in Windsor that's going to impact 4,500 workers. What's Canada's unemployment rate right now, and where do you see it going?
Well, it's around 6.9 right now, which was up from 6.7 last month. That's a pretty big jump. We also got this week the new industry level jobs report, and that showed a very large decline in service sector jobs for the second consecutive month, over 50,000 service sector jobs lost. Now, the reason that's so noteworthy is it's not just the goods sector, right? If it was concentrated just in the goods sector, then you can say this is a tariff effect, it's all these auto firms, but this is much broader than that, and it's starting to affect the economy across every sector. So that's a major recession indicator. Doesn't mean we're in a recession, but you keep losing those service sector jobs for, I would say, 2 or 3 more months consecutively, then I'm happy to call that a recession, or I guess unhappy. So that's a big part of the puzzle. So why is that happening? Well, there are a couple factors at the same time. Remember, like I said, we have low structural growth, so we're already starting from a low baseline. You add all of the tariff-related uncertainty, and what happens to unemployment is not just layoffs, like you mentioned. All those are examples, and there are tons of smaller firm examples where they're laying off 5 people here, 10 people there. But it's also the slowdown in hiring, right? The unemployment rate is like a treadmill. You have new people going into the labor force all the time from population growth. And so to stay in place, you've got to hire new people. Well, all the uncertainty about tariffs, and I think some of the uncertainty earlier this year because of the election with government policy, although that's a secondary factor, that has frozen all these capital expenditures and all these hiring plans in place. So layoffs up, hiring down, that's a recipe for higher unemployment. And the Bank of Canada has been very slow to react, which I'm sure we'll talk about.
So you and I are both located in Toronto, and a big part of the Toronto economy in Southern Ontario is the services industry, and more specifically the financial services. So when you talk about all these jobs being lost in the service industry, is that part of the financial industry or the financial services industry?
Yep, it's financial services, it's some things in just, general personal care services. It's retail. A fair amount of it's been in retail. And so it's just we're seeing it across sectors. It's certainly not concentrated in just the financial sector.
And when you said the unemployment rate across the country is 6.9%, that was up from the last month. Well, what's the trend? When did it bottom here in the last few years? And I just want to get a sense of when the unemployment rate started ticking up.
Well, what we had, a few years ago in 2021 and 2022, when this unemployment rate really bottomed out, firms were behaving in a very unusual way in the immediate aftermath of the pandemic. This is very true in the US, but there's some in Canada. There was a lot of what you might call defensive hiring and defensive non-firing. Even when the Bank of Canada went into a tightening cycle, which often causes a lot of layoffs, firms were kind of burned by the labor shortages during the pandemic. And so they laid people off less than they normally would. And that seems to be done with, right? Layoffs are very much back on the menu. Employers are looking around, they're seeing all this unemployment and all this surplus labor, and they're saying, yeah, if we fired people, we're not going to have any trouble hiring them back in 6 months. And so that's what I think is the sort of underlying structural change compared to 2.5 years ago.
In the province of Ontario, the unemployment rate is 7.8%. Okay, so that's significantly higher than what it is across the country. You already mentioned it was 6.9%. And this 7.8%, that's a 10-year high. Where do you see the rates going? Okay, you mentioned earlier that you were very close to being in a recession if we're not already in one. How high can these unemployment rates get?
Well, I could easily see them getting a point higher if you have 3 straight quarters um, of negative or very flat growth. The sort of rule of thumb is you want to think about um, even growth below average can raise the unemployment rate. And so that's what we saw in the first quarter. That's what we saw last year. We didn't have a recession last year. What we had was below average growth, below potential growth. And so I wouldn't be surprised to see unemployment rates go a full percentage point higher, especially since the Bank of Canada doesn't seem to be acting very aggressively right now.
One other number I want to throw at you is the youth unemployment number. That's for ages between 15 and 24. It's at 14.1%, highest since 2012. And I think one of the things that's impacting all of this, not only in Toronto and across Canada, but also in the US, is uncertainty. And we keep hearing this word all the time from every company that reported their Q1 numbers here in the last couple of months. They all said because of this uncertain environment associated with trade wars and tariffs, it's having a big impact on consumers and how they're spending money. A number of airlines, Delta, American, Southwest, all said people just aren't flying because there's uncertainty as to what's happening within the economy.
Yeah, that's right. And when there's a hiring slowdown, that's going to tend to affect new workers, i.e., young workers, especially those graduating from college or other educational programs. It's going to affect them the most, right? Sort of when firms slow down their hiring, then they can also be a little choosier when they do have an opening. They'll tend to prioritize people with more experience. And so then that unemployment surge tends to get concentrated among younger people, and that number can absolutely go up, and we would expect that to go up for the rest of the year. And it's already very high, as you said.
So we talked about the economy as measured by the GDP, and it's definitely slowing down. We talked about the unemployment rate, and that's definitely going up significantly. I want to talk about the impact of these two elements on the real estate market. And more specifically, I want to focus on the Greater Toronto Area, both residential and also the condo market. There's an index, it's called the Crane Index, and it measures the number of construction cranes across North America and major cities. And believe it or not, Toronto is number one in this index. There's 106 cranes currently in the Greater Toronto Area. Number two on the list, okay, and keep in mind this is major cities across North America, is Los Angeles, and they have 42 cranes. So it gives you some idea of the amount of construction going on with high rises and with especially in the condo market. And so why don't you tell us a little bit about what's happening with the condo market here in the Greater Toronto Area?
Right. So if you look at both Vancouver and Toronto, and I have a chart on this, they've both been seeing outright average declines in the year-over-year percent changes for prices, and that's been true since early 2024 in Toronto, and for since mid 2024 in Vancouver. You also see, if you look at the country as a whole, we got all the way down to almost zero, completed and unoccupied condo units in mid 2022, like an incredible low. There was so much housing demand in 2020 and 2021 that it really eroded all that excess supply of condos. And starting in early 2024, we're right back to having a huge amount of excess supply, and it's actually larger now than the pre-pandemic level. And so that sort of excess supply is part of what's driving this condo price. It does seem like, though, there is some evidence of slow normalization. So you mentioned the Crane Index. So I have another chart called Multifamily Construction has Shifted from Condos to Rental Apartments. Condo construction, in terms of units coming online, really surged in 2022 and 2023 in response to this shortage. But now that trend's starting to reverse a little bit. Obviously, this is a very lagging indicator, right? It takes a couple of years or even 5 years for some of these projects to be developed. But now we're starting to see a gradual shift back towards multifamily rental apartment construction from condo construction. But arguably, there's oversupply in both sectors, right? So I think we're going to see a disinflationary trend for both over the next at least 6 months and maybe longer than that.
And just to further reinforce how many condos have come online here in the last few years, in 2024, almost 30,000 units came online This is just in the Greater Toronto Area. And in 2025, it's going to be a like amount, probably more. And then, of course, there's more coming on in 26 and 27 because, as you mentioned, when these projects get financed and when they get approved, it takes basically 5 years or 6 years before, when they start digging in until people can
Right.
move in. So now we're at this level where we got all these units coming online and nobody can buy them or they're walking away from them.
Right.
Something else that I want to touch on too, some people might not be familiar with this, but it's the assignment market. Basically, you're trading on futures. So before the condo is even built, they have to sell, I believe it's 60% of the units. So people would buy pre-construction. Let's just say they bought it for 100,000 and then they would hope to flip it for 200,000 in the coming years. And what's happened here in the last few years, because we have so much supply coming on, people are just walking away from those agreements. And so now you got the construction company or the condo company just sitting there with all these empty units. So I don't know what's going on there, and I'm not too sure how you track that, but that would be interesting to see. I guess my other question to you is, I don't know how well you follow the Canadian banks, but is there one or two banks that has a big exposure to the condo market?
I can't really speak to the bank exposure question. I will say one bright spot is like in terms of capital levels, all the banks look reasonably good, but I certainly you would expect all of them to take an earnings hit because they all have, some amount of condo and multifamily apartment exposure on both their corporate loan books and their individual loan books. So, but which banks would be hit more, I can't really speak to. The other thing I want to land is that assignment question is really interesting. So one of the leading indicators in 2007 and 2008 of future house price drops was people walking away from closings and assignments and exactly this kind of thing. And it was very concentrated at the regional level. In some of these super hot American condo markets, like in 2007, 2008, like South Florida, you had 10, 20% of people walking away from closings. Like they had signed something and they weren't showing up at 60 days later. And it's because the drop in the price of the condo in that short time was larger than the down payment they'd put on. Right. And so, that's sort of not showing up at closing for assignments. That's a classic leading indicator. And unfortunately, there's not very good data at the national level on that, but that's a good thing to track. So condo firms, as you said, there's this 3 to 6 year lag time. A lot of the supply that's coming online this year and next year and the year after that are all decisions that were made in 2021 and 2022. And I think a lot of these real estate firms made serious errors. They looked at this post-pandemic surge in households. People wanted to own, and interest rates were incredibly low, unseasonably low. And that just wasn't representative of what the market is normally like. And so I think a lot of bad decisions really got made in that time period.
And I think from what I've read, a lot of individuals were buying these condos as an investment. So they just weren't buying one or two. They might have been buying three, four, or five of them. And the other thing that's happened here in the last year, 2 years, the Bank of Canada realizes they got a real problem on their hands. They've been very aggressive in cutting rates. How many times have they cut rates now in the past year?
I
Seven
think
times, eight times?
yeah, exactly. And so with 225 basis points of easing and more to come, but I think even though they've cut a lot, policy is still just around neutral. It's not, we do not have an easy monetary policy right now. We have maybe a neutral policy at best, maybe even slightly restrictive if you think that the neutral rate is maybe a little lower than the Bank of Canada thinks. And so, it's really hard to look at our economy right now and say we should have a neutral rate. Surely we should have a rate quite a bit below neutral if you look at the Taylor rule or any sort of other, measure of what monetary policy should be.
And where I was going with that is that there's in 2025, there's over 1 million mortgages coming up for renewal. 2026, I believe it's 1.2 million. And of course, people are going to be refinancing at significantly higher rates than when they took on their first mortgage back in 2020. And once again, just to provide a little bit of context for our American viewers, In Canada, you can only get a 3 year or a 5 year mortgage. Okay. So we got a lot of people renewing at significantly higher rates. And this is a problem because maybe in 2020, your mortgage payment was only $1,000 a month. But here we are 5 years later, and it's doubled to $2,000 a month, or maybe it's higher. And so that's going to have a very onerous effect on or impact on people's wallet. So it's
Yeah,
going to be interesting to see what happens here in the coming quarters.
absolutely. And the Bank of Canada knows about this problem, right? And it's one of the reasons why I do think they'll ease a little quicker than is priced in, just because they kind of have to, right? The hit to consumer spending from this big renewal cliff is coming. I think a lot of it's going to be concentrated in the first half of next year.
So we have a new prime minister in Mark Carney, and the Liberals won their fourth mandate. And so they've been in power since 2015. What do you think if you were to sit down with Mark Carney, what advice would you give him? What would you tell him that he should consider to reignite this economy and get it growing again?
Well, he says a lot of the right things, right? They talk about reducing interprovincial trade barriers, right? And that's a major thing. There are some products where it's easier to sell something in Asia or Europe than it is to sell from Ontario to British Columbia. I mean, depending on the product, right? And so, he's talked a big game about that. He's talked about critical minerals and maybe, some provinces. I've seen, the Ontario Finance Minister this week was talking about we should be doing more refining of critical minerals at home and moving up the value chain in our commodity exports, instead of just being the old saying about the Canadian economy is that we're hewers of wood and drawers of water. In other words, basically raw commodity exporters. So anything we can do to move up the value chain, that's good. And we need to be looking at investment, and that means R&D in the public sector. It means encouraging R&D in the private sector. And, they have a few things in the hopper in terms of tax credits and those kinds of things to encourage that. But that all really needs to be scaled up. Now, the problem is all that stuff I just said, that takes a year or two or three to kick in, right? They should have done it 5 years ago, but they didn't. And now, at best, we're looking at 2027. Another good example, pipelines. We'd love to see some east-west pipelines. Well, even if you put the policy in place, let's say they decide tomorrow they're going to do it. Well, it takes 6 months to do the policy. Then it takes a year to do all the regulatory approvals and the site planning. So you're looking at early 2027 before you're even, building stuff. And they're not finished for years after that. I mean, so, there's lots to do for the structural reform agenda, and we should do it. But that doesn't solve the cyclical problem that's happening right now.
You didn't mention taxes.
Hey, I could talk about taxes for another 20 minutes. I mean, Canada's tax policy has a lot of unusual features that could be reformed. I think we're going to be somewhat negatively impacted if you look at the structure of the House Republican bill and some of the retaliatory tax provisions that they're vaguely written, but that could well apply to Canada. We got all kinds of problems there too.
Yes, and this is something else that kills me. I mean, we are continuously being taxed on after-tax dollars. It's virtually impossible to get ahead in this country because of the taxes. Now, the one positive thing Mark Carney has done, he got rid of the carbon tax as soon as he came into power, which had a big impact on the price of gas. Dropped 17 cents a liter, give or take, depending on where you are. So that's helped out a lot. But there's so much more they can do. I speak to a lot of guests across North America. So I always ask people what they're paying for a gallon of gas. And it's amazing the range across the US. If you're in California, you're looking at $5 a gallon. If you're in New Jersey, you're looking at 250, 275 a gallon. We're currently paying $1.35 in Toronto, which is the equivalent of 375 a gallon. So we're still paying significantly higher than what a lot of people are paying in the US.
Yeah. And the other thing that Carney did, and let's give him credit for seeing this, is they got rid of the planned capital gains tax increase, which was going to go into effect, which they scrapped. And it's really interesting how close the conservative and liberal platforms on taxes became in the most recent election, right? Poilievre was running hard on, well, we're not going to do this capital gains increase, and we're going to scrap the carbon tax. And then Carney just said, okay, we'll do those things too. And Poilievre didn't adapt really by having other bigger tax reforms. And so we ended up with an election that wasn't really about tax policy at all. It was actually an unusually narrow gap between the parties. There are a couple differences, but that was one interesting feature. If ever there was a time to be proposing a big, tax reform as a conservative party, I think this would have been it. And so I view it as a little bit an opportunity wasted.
So the long and short of it is the Canadian economy is in a disastrous state, and it's only going to get worse probably in the coming months. Now, our biggest trading partner is the US, and they came in with a very weak Q1 GDP number. It came in at 0.3%, marking the first decline since 2022. Now, much of that was driven by imports, which increased 41.3%. This surge came on the back of caused a trade deficit and also subtracted 4.8% from GDP growth. But where do you see the US economy going in the coming quarters? And I ask you this because of course, what happens in the US has a big impact on Canada, and especially if we enter into a full-blown trade war.
Well, all of the US data for Q1 and also for Q2 is going to be driven by these very strange tariff distortions in exports and imports and in inventories. And so the US trade data came in this week is showing almost the reverse. Exports going back up and imports declined massively. Now, again, this is backward looking, but once the higher tariffs went on, you know, the earlier import surge was to get ahead of the tariffs. Then the tariffs went on, imports collapsed. So that's a temporary support to GDP insofar as people were going back to buying more domestic goods. But now we expect if the tariffs are back off again temporarily, you'll see another big import surge in June and July. And so you're just getting whipsawed in the data. And the underlying trend, though, is pretty bad, right? Consumption growth, whether it's of domestic or important goods, has been growing a little bit more slowly than you would expect. Durable goods orders have been on a more not as strong as you would like to see. You know, the durable goods report this week was quite soft. And business investment, just like the Canadian case, firms are on hold. And so definitely the net effect of all the uncertainty, it might be very volatile quarter to quarter. I wouldn't be surprised to see Q2 actually look pretty strong just because of these tariff distortions, but the US growth rate is going to be well below potential for this year.
And what about Q3, Q4? Do you see the US going into a recession?
I see the US going close to recession. I mean, if you put a gun to my head and asked me to pick a number, I'd say, 0.7, 0.8, 0.9%, something like that for each of Q3 and Q4. The non-farm payrolls are going to come out next week, and that's such a key indicator. We aren't seeing the layoff surge in the US that we've been seeing in Canada, right? And that's the biggest difference between the two economies is firms are hanging on. They've cut their hiring, they've cut their job openings. Hiring is down to basically like a pre-pandemic level. But as long as they have a robust job market, you're still going to see GDP growth. And so I would really watch that non-farm payrolls report. If that's below consensus, then yeah, we're on recession watch.
So we started this conversation talking about the Canadian economy as measured by the GDP and how weak it's been. And we also talked about how the unemployment rate continues to climb and people aren't spending, companies aren't investing. You said there's a threat to the US going into a recession later in the year. There's still this potential or overhang from a potential trade war, which could have disastrous results in the Canadian economy and specifically this economy in Southern Ontario. But how bad do you see things going in Canada? Like, why don't we just summarize? Like, where do you see the economy going in terms of GDP? Where do you see the unemployment rate going?
I'd say we would see an unemployment rate going to 8% over the next 3 quarters. And that's in a base case where there are at least some tariffs staying on. So the sort of other piece of the puzzle we haven't talked about yet for Canada and forecasting Canadian GDP is commodity prices. Commodity prices, the year-to-date decline in oil and all the industrial metals, copper, and all these things, everything other than precious metals, which are up because they're sort of gold's a hedge against uncertainty. But every other commodity is down dramatically. That really constrains our GDP growth a lot. And so in our base case where there's some tariffs on China, a lot of them got struck down this week, but we expect either Trump to win on appeal or use other sections of legal authorizations to put a lot of those tariffs back on. In that scenario, commodity prices and oil prices in particular stay low. Yeah, Canada should go into a recession or very close to it, right? Like the best you can hope for is going to be plus 0.2, plus 0.3% in Q3 and Q4. But as we've been saying all year, there's just so much uncertainty. It's not impossible that a lot of these tariffs go away. U.S. economy rebounds on strong AI investment in the second half, and Canada avoids a recession. That would not be a shocking scenario at all. I just don't think it's the most likely scenario.
And I didn't ask you about the Canadian dollar. It's currently at or near a 20-year low, and it's basically just a reflection of what's happening within the country in terms of our growth, et cetera. Where do you see the Canadian dollar going versus the US dollar?
Right. So the Canadian dollar's rebounded over the last 2 months or so. And if you read the press coverage, everybody says, oh, this is great. The Canadian dollar is right back up. Well, it's up way less than almost every other currency. The euro is up almost 10%. The yen, the pound are both up over 8%. And it's only Canada and also the Australian dollar, because we have so much commodity price exposure and because Canada in particular has had so much tariff exposure, we're up, but just barely. And that's because currency markets see all the stuff we've been talking about. They see the terrible commodity price outlook. They see the Bank of Canada having to ease more. They see the slow structural growth. And so I would not be long the Canadian dollar at all. If it's an open question whether US dollar weakness is going to decline. And so if you're interested in like a currency trade, something like long the euro diff to the Canadian dollar or long the, Norway or Sweden or some other, European currency pair. Um, I think that there's just very little upside in the Canadian dollar relative to the amount of US dollar decline, right? That's my hedge. If the Fed stops being so behind the curve, you could see general dollar weakness. So then the Canadian dollar might go up just because everything's going up. But we see much less Canadian dollar appreciation against the US dollar than every other currency. And that's very important to understand is the difference between Canadian dollar strength and US dollar weakness.
Good point. So yeah, the Canadian dollar is just killing me. I can't even go to the US now. Everything's costing me like a 40% premium.
Yeah.
So, Robert, that was a great discussion. I wish you had more positive news, but anyhow, this is the way it is, and this is why we have these conversations because we're trying to educate our viewers and we're trying to determine how we move forward and navigate these financial markets during these crazy times. I want to thank you very much for making the time. If somebody would like to learn more about Rosenberg Research and the services that they offer, where can they go?
You can go to our website, rosenbergresearch.com, and request a free trial. Ask to speak to our sales team. We're always happy to accommodate people who are interested in the research.
Robert, once again, thank you.
Thank you.